This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Hello, and welcome back to Not Fintech Investment Advice. My name is Alex Johnson, and I am joined, as always, by the wise and powerful author of Fintech Brain Food, Mr. Simon Taylor. Simon, great to see your face again.
Great to see your face, sir. Most people can't see your face. They're listening to this. So thank you, everybody, for listening. I love doing this show.
I am so glad to hear you say that. We've been doing it for a while now, so I'm happy to hear that you still don't mind spending an hour with me chopping it up on different fintech companies. I feel like one of the things I'm constantly surprised by, Simon, is I kind of think sometimes I'm going to run out of companies or not be able to find something to talk about. And then I'm prepping for the show, I'm doing a little research, I'm thinking about different things to do. And I'm like, ooh, I could do this company. I could do this company. Fintech just gives and gives and gives. There's so many interesting things to talk about.
Once you develop your antennae to see them, you start seeing them everywhere. So how do I find 4 fintech companies a week? I just have a little note to myself in my phone, and whenever I see one pop up, I just add it to that list. And you can't unsee them. And what's crazy is it'll pop up everywhere. It might be somebody's following me on X. I see something on LinkedIn. My Google Reader alerts me to something. I don't know what it is, but it's kind of everywhere. You just need to tweak the antenna. There's so many fintech companies. I'm doing a finger antennae now.
He is. Simon's got his antennae up, and he's sort of looking for. No, that's exactly what it is. I mean, it's it does take a little while to get the antennae tuned to kind of pick up on the right things. And I will say, X is great. There's a whole fintech community there. There's lots of good sources for this kind of stuff. I read This Week in Fintech religiously because they do a really great roundup of all the news.
I have absolutely done it where I've had a bad week, a dry week, and I've just gone to TWIF, the This Week in Fintech.
You're
help me out here, Nick.
So we appreciate you, Nick and team, because we definitely rely on lots of others in the ecosystem. Simon, as always, we're not going to give investment advice, but we are going to talk about companies that are interesting to us and sort of share our perspectives. As my valued co-host, Simon, I would like you to go first.
All right, you might spot a theme with my 2 companies today.
Okay.
The first one is called Rail. Rail is a stablecoin money movement API. You can move money internationally with stablecoins using its infrastructure and its APIs. They help neobanks and fintech companies build bespoke workflows and use cases. Now, you immediately wonder, wait, doesn't that sound an awful lot like Bridge, like BVNK, a lot of other folks? So I asked them, what makes you guys different? And they said, well, look, we've got 12 partner banks. And if you speak to anybody about building partner banking relationships in cross-border, partner banking's hard in a single country. Now try and do it in 12 different countries. And they're focusing primarily on B2B flows. So we're not talking about just payouts. We're not talking about remittances. We're talking about businesses and commerce. And I thought that was interesting. And they said in the past 12 months, they've processed $11 billion of transactional volume. So that's a meaningful amount of volume. It's definitely not nothing. It's not Stripe's 1 trillion. It's
right. Sure.
It's 10 basis points of that, but it's also not nothing, and it's a growing trend. So what say you, Mr. Johnson? B2B, it's done quite well for Wise. It's been a growth engine for some folks. B2B cross-border, do you see opportunity here?
I definitely do. Yeah, I mean, I think that I've probably talked about this in different instances, but B2B always seems to follow B2C just constantly, right? B2B just trails B2C and whatever.
Like that weird sidekick. It's just following you around. It
really is. Just following you around, and it's oh, wow, hey, Robin's back there following Batman. And then hey, maybe we should pay more attention to Robin. That. It's just B2B is always that way. But what you don't realize because of that dynamic is B2B dwarfs B2C almost always, right? In payments, in treasury management, in banking, like everything. B2B is just so much bigger in terms of volume, payment flows, transactions. And so I think that it makes a lot of sense to sort of jump the stablecoin conversation directly to B2B. And obviously, and you and I have written a lot recently about stablecoins. So listeners are probably familiar with our general thinking on the subject. But, this idea that there are use cases for stablecoins where they actually are a better alternative to existing rails. Cross border is number one with a bullet, right? Like that is still the sort of, I think, number one, clearest, most obvious example of where that adds a lot of value. You can dig into how correspondent banking works to get a flavor of like what the alternative is to it, but it's pretty unpleasant. And I'm glad you mentioned Wise, right? Because I've actually spoken to some of the folks in this company, including the folks at Rail, and you know, they're pretty clear-eyed about where they add value and where they don't, right? I think anyone who's actually trying to sort of build stablecoins for non-crypto use cases, right? Stablecoins sort of play its own whole role in the crypto ecosystem. That's sort of one version of it. People who are building more in sort of the off-chain world and trying to sort of enable other use cases, they're pretty clear-eyed about, look, like we don't necessarily think what we're doing is that different from an overall cost perspective than what Wise has enabled. It's just stablecoins allowed us to catch up to that much, much faster and to be able to jump into that world much faster. That's obviously why Stripe was interested in Bridge, I think, as you've covered in numerous times on your podcast and in the newsletter. So I like this. I also think the other thing I've taken from the conversation I've had with the folks at Rail is there is also a very sort of practical streak around, look, stablecoins are a really great rail. It doesn't necessarily mean it's the only one that will use or support or integrate, right? And so the idea that we don't want people to use this because it's stablecoins. We want this to be used because it's the best solution for B2B cross-border transactions. And stablecoins are probably going to be something under the surface. We actually don't ever want anyone to know they're using stablecoins to facilitate this transaction. We will use other payment rails or integrate into other systems for last mile type stuff. Like we will just make it work and sort of abstract that complexity away. That's the right attitude to have. Because the other thing, and I've written about this too, that I always get a little suspicious of is when people really like pound their chest and go, we're doing a stablecoin thing. That always seems more like a marketing VC-ish kind of thing than it does like I'm actually trying to build for customers.
Yeah, it's the answer stablecoins. What's the question? Is not a useful starting point. I spoke to another founder at a company called Nelos, Aitan, and he said, I'm in a game of bips and speed. So I'm going to get you slightly better basis point pricing, and I'm going to get your money there faster. Mm-hmm. If I can do that for you, you don't care how I do it. You care that I did it. And what I care about is that I made a margin on the process and I didn't take undue risk in the process. So like all things, the competitive advantage is being able to do it better, faster, cheaper. And in the better is in managing the compliance of the last mile with some of this stuff is extremely difficult because you're dealing with banks in other languages, in other parts of the world. That is kind of non-trivial. So yeah, the stablecoin is the answer. What's the question? Just kind of goes away. And there are a lot of people, because stablecoins are hot, looking for stablecoins. I literally filled up an entire 4 fintech companies with stablecoins this week. I could probably do it next week. I could probably do it the week after.
Speaking of our friends at This Week in Fintech, didn't they launch a stable specific newsletter, right? That's coming out every week. Like, I mean, there is so much news and sort of entrepreneurial activity in this space. And, this was happening before the Stripe acquisition of Bridge, but like when Stripe spends $1 billion on something, people tend to sort of flock to that thing as well. So I do definitely think that it's gathering a lot of attention. But yeah, to your point, like it has the potential to be a better answer in certain areas. And I guess the question I would have for you, just to sort of round this one out, Simon, is none of this really solves for customer acquisition, right? And one sort of just open question I have, and I honestly don't know the answer to this. I'm just sort of like floating this out because it's the thing I'm confused by is when you're, especially if you're like a small startup and you're building a global, sort of cross-border B2B payments infrastructure company, how do you think about go-to-market and customer acquisition? Because the people who are going to be benefiting from and using your infrastructure, just as you're sort of illustrating the problem, they're scattered all over the place. They speak different languages. They don't all like go to the same places. So I imagine it's sort of a partnership driven strategy where you're looking for people who are sort of touching parts of these payment flows already and then trying to offer them better infrastructure. But do you have any insights on, like, from a go to market customer acquisition perspective, how these stablecoin infrastructure companies kind of grow? How does that look?
Yeah, that's probably the most interesting part of the whole space. Is the answer really varies. So if you look at somebody like a Bridge and BVNK actually are quite similar in that their customers are large Western companies looking to make typically payouts and maybe collections to long tail markets in the global south, like Deal doing payouts to contractors in Latin America. Or in the case of Bridge, SpaceX is one of their biggest clients. You're using Starlink anywhere around the world, and you can pay in dollars, and Starlink gets paid immediately. Word is that Starlink is one of Bridge's biggest customers. So by acquiring Bridge, you get Starlink as a customer of Stripe. So there's kind of like some logo synergy there. And if you believe Starlink's going to be big, or the concept of it, then it's really powerful. So it's like this big Western company going global. This is the infrastructure for your global payments. But the other model is there's a lot of commerce happening in those markets, period, that wants to come into the West. So if I run an e-commerce store from India, from Brazil, from somewhere else, how do I take payments from the West? And this is where folks like Rail and others in the B2B commerce space are seeing a little bit more activity, which is how do I get those companies? And so they're doing classic sort of targeting, demand generation advertising. It's go find these customers, go work with the local Shopify teams, go work with all of your distribution and channel partners, go do the advertising as you would do if you were selling to SMBs, but just do it in those markets and sell them this ability to make the payments in that particular way. The thing with these guys is they're selling to the people who sell to the last mile. So I'm a neobank in Latin America and I want to offer my customers the ability to accept payments from around the world. I would work with Rail. So there's like a couple of, it's B2B to B is the way to think about it.
Yeah, no, that makes sense. It's fascinating because, as you said, I mean, so many of these new networks that are being developed are new, right? They're cross-border, they're enabled by the internet, and so a lot of the, I think, playbooks for how do you grow this type of business are kind of being written right now because this type of cross-border commerce just hasn't been feasible at a lower level. Obviously, it's existed for like major corporations for a long time, but as it filters down to like this idea that there could be a small e-commerce shop in Argentina that wants to sell in the US. Like that would have been absurd to think about, 30 years ago. And it makes sense today. And like, what's the infrastructure that supports that? All right, Simon, that was great. Thank you for a little more stablecoin education. I appreciate you as always, sir. Can I give you my first company?
Please do. I got my notepad ready.
I appreciate that. All right. So my first one is Anchor.
Anger or anchor?
Anchor, yeah. Like a ship dropping an anchor. Although I don't know, maybe they're angry. I don't think they're that angry. They seem actually pretty calm and sober and responsible because what they do. And if Anchor gives you sort of crypto vibes, like don't worry, like it's not it's not that. It's not anything having to do with algorithmic stablecoins. It is an integrated platform for small businesses, particularly like services businesses. So think like accounting, bookkeeping, that kind of thing, to do integrated proposals, agreements, invoicing, and payments. So the basic idea is they provide one single end-to-end platform for everything from initial proposals to customers that they're going to work with, all the way through to invoicing and payments. And this is a model that I've seen crop up a couple of places.
Yeah.
I was trying to think of the name. You might remember, Simon, but there was a kind of fintech adjacent company that popped up that was getting everyone on Twitter excited, that was like a competitor to DocuSign. Do you remember the name of that company?
No, I can't, but I'm Googling it frantically. I know it was the guys at BTV that invested in it, so I'm trying to find who BTV.
Simon will find it. It was kind of making the rounds, but it was the same idea of like, instead of having just the one piece, which is like signing a document, why not have the entire workflow end to end be integrated? And, it's fascinating to me because it's kind of, in some senses, an obvious idea, right? Like, why are we just having this one little slice of capability? Why not just bundle all those together? It's more convenient for small businesses in particular. Like, one thing we know about small businesses is they like to have a fully integrated solution where possible, because they don't have a lot of time. They don't want to deal with 35 different SaaS software products. They want to deal with like one or two if they can. So integrating more jobs to be done into one platform makes a lot of sense. But the other thing I was thinking about, because they really push this idea of automation, right? Like, we can enable automated bill payment, automated collections, right? A lot of people don't pay their bookkeeper in a timely fashion, right? Like, those bills don't get closed out quickly. And it's a pain to have to like track down the invoice, go into a different system that you used for the proposal, then send a reminder via email to the client to have to pay their bill. Like, all of that is very sort of annoying and non-integrated. By integrating it together, you can automate things like collections. So you can just have the system automatically send emails, and it has all of the context for the entire relationship with the customer. And context is kind of, I think, the key word here, because Simon, as you and I have talked about a lot on this podcast, like, all of these workflows that we talk about every month are all going to get eaten to some degree by AI and AI agents, right? And to me, when we think about AI and we think about automation, the most valuable places for that to be applied are the places that have the most context on what the workflow is and all of the data necessary to act on that, right? And so as I think about where these things can add a lot of value, I think they have a great deal more value if you have a very large surface area for them to play in, right? And to like apply their intelligence to. Whereas if you're just handling one little slice, if you just have a wedge product that does this one piece really well, that's great. But the ability to get that 1+1=3 sort of leverage using AI and using other forms of automation, it's just less because the surface area is less. And so I wonder if we are going to see more sort of integrated by design solutions that handle a larger portion of the workflow and then create the space for more of that AI and automation. Does that concept make sense to you?
Oh, it completely does. I think the nature of AI naturally lends itself to complex workflows. And for the record, the company you were looking for was agree.com.
That's it. Yes, thank you.
And so they talk about the same thing. They talk about automating collections. They have customers, happy customers, smiling, giving them recommendations on the page saying, I don't have to chase payments anymore. And it's if DocuSign and Stripe billing had a baby. It really is putting all of those things together. And it just seemed both of these companies, so Anchor and Agree, both begin with A, but they also have that annoying habit of why didn't this exist before? Like, this was obvious. Why didn't DocuSign do this? And that's the sign of something that's going to become a standard. Like, surely Ramp is going to build this soon. Like, why wouldn't you start there? What I think is fascinating about this is they've kind of gone upstream. They've gone ahead of where you start to send out the invoice or even create the invoice, which a lot of neobanks have moved into, to the agreement, which is where you're often, will people start going up into the CRM? Will they start going up into marketing? Like, how early in the, like, touching this customer do you go? Because the more of these workflows you can start to tie together, to your point, the more context you have about the agreement, the more context you have about the payments. But getting to that means you need the agreement, you need the data, you need the underlying missing pieces to kind of glue all that together. And generative AI is just this great glue when it's packaged well between those workflows, and it can get you some of the way there some of the time. So I don't know if that answered your question, but hopefully it scratched an itch.
Yeah, it does. No, I mean, well, first of all, thank you for finding Agree. I knew it had like a simple, elegant name, and I just couldn't remember it. Google failed me. My Google skills failed this show, maybe is a better way of putting it. And yeah, I mean, I think that it's just fascinating. When you pull on that thread, it's really interesting, right? Because it's like, well, you can just go further. You can go all the way up into marketing, prospecting. Like you can like eat the entire life cycle. And there probably is diminishing returns at some point, right? You can't be like great at everything. But I think we've had a few different companies over the last year, 18 months that we've talked about that are sort of trying to take this like, there's a value in bringing all the pieces to the table to start play, which is just very different than the classic sort of SaaS VC backed company model of disruption, which is like wedge product, do one thing amazing, and then sort of expand from there. And that works. But I do wonder if like the strategy for breaking into a market might be more defined by integration than by best of breed. And that would be like a big change. And I wonder if it's somewhat the function of sort of AI and automation and like this need to have more context and more data, but also it might just be kind of the cycle of how these businesses evolve, and just sort of like maybe it's a macro reaction to there are so many great wedge products out there, but I don't have anything that's integrated or solves my problem. The other thing that these guys do that I just caught my eye and I thought was interesting, and again, it's like sort of zig when everyone else zags kind of a thing. They have a pricing model where they charge a flat $5 fee per transaction. So no subscription to the software, and they don't charge a percentage of the transaction, which is also pretty common in this space. And, I find that fascinating as well, just because I do think that when everyone is sort of trying to play the same game from a pricing perspective or a business model perspective, you can be a breath of fresh air by just doing it differently, right? And sometimes I think we get a little wrapped up in the axle about that, but like, I don't know, I imagine a small business owner who is ultra frustrated because they've sort of honed in on the number of like SaaS subscription fees they pay per month, and being able to say like, we don't do that, we just do this flat $5 fee, we want it to be easy for you to use. Like that's just a different way of kind of positioning your product. So yeah, in a number of ways they seem very sort of counter to a lot of the traditional patterns that you see.
Yeah, and if that could be a good thing, it could be a bad thing.
Totally.
You said there was sort of going after the small businesses, the accountants, and that sort of space. There's a lot of like platforms that already existed where accountants could send you a proposal and billing was baked right into it. But also that is the portal where you submit them all of your tax documents and all of your invoices. These things exist. This is just a slightly neater version of a thing that exists and is kind of janky. So I wonder about this segment. Like, what's their right to win in this segment? And then on the pricing side, that is neat. That is really, really neat because
it's interesting, right?
But I also think the other way of like who's the first best customer for this. So I looked at Agree, right, and on their page, it's often sort of the solopreneur. It's the person who is struggling to chase payments and is overwhelmed by admin. Like this is such a good fit for that person who would have probably been using DocuSign anyway, and then was probably doing something else, and it wasn't kind of ideal, and it didn't quite fit in with their existing Mercury or their Ramp or whatever they have underneath the hoods. But those other two products are either charging you on a like SaaS basis, to your point, or they're taking a percentage of the transaction. So how many agreements, how many anchor documents do you need to be doing at $5 per transaction per month for the customers to kind of add up to you? Probably not many. Like, what's my cost of acquisition on a customer, and then what's my kind of servicing cost? Well, servicing is software; it doesn't cost me anything. So if they're making 3, 4, 5 transactions really per month as a relatively small business, then they'll be fine. Maybe they're signing 10, 20, 30. Then my average revenue per user starts to kind of go up a little bit. But what was I making on a per seat model or on a monthly model? Was I making $60 a month? So I don't know where this nets out. I'd love to kind of model that out and see what their pricing kind of plays with. It's fascinating. They must have done that, but I'm
sure they have. Yeah, I mean it's fascinating. Like the pricing thing, I'm always just fascinated by because my general theory of pricing is that pretty much every model nets out to roughly the same, and a lot of times it's more the psychology of how you position it. Yeah. And I wonder if for these kind of smaller service-based businesses, if they're just like really sick of the sort of dominant pricing model. And this is a way to sort of counterposition it, even though if you model it out, it kind of roughly comes out to be about the same. I wonder if there's sort of a psychology element to it. But yeah, I mean, it's a good point about kind of right to win. The other thing I wonder about in this space, and I think about this all the time, is you have Ramp, you have Mercury, you have Agree, you have all of these like great platforms that do versions of different things, and obviously they can kind of copy each other, and they do a lot. I wonder how defensible a moat you can build in this general area by specializing in a segment of businesses. And again, it probably has to do with like how sort of different the workflows are for one segment of businesses versus another and what jobs to be done you're tackling. But like using collections as an example, I've always sort of felt like collections works a lot better when it's tuned to the thing that you're collecting on and the customers that you're serving. Like it's generic collections, I think, work a lot less well than ones that are sort of tailored to like the customer, the life cycle of the transaction, the amount owed. All these things are kind of bespoke to the product or the industry. And so I wonder if like it's more on the back end where some of that competitive moat kind of creeps in, where it's like, yeah, you could use, I mean, shit, like Intuit QuickBooks does this, right? Like it'll sort of handle all of these different jobs, but it's designed to sort of be, a B- for everyone rather than like an A for a very specific segment. So I wonder about the defensibility if you sort of specialize in a particular vertical or industry. And I honestly don't know the answer to that. That's just a theory.
Yeah, well, and also the capped upside by specializing in that vertical.
That's exactly right.
There's a whole big debate at the moment about how do you price for AI agents in bunny ears, because the per seat model people have grown tired of, the subscription model people have grown tired of, and there is a move towards pricing on outcomes. So
I've seen that.
If the human labor was X per hour, then the agent is Y per hour for a similar sort of outcome. So the outcome here is your agreement is done and your payments come in a little bit faster. I could see something where AI is making this process from creating the contract much faster, to creating the recurring billing much faster, to chasing the payments and the money getting in much faster. So what value is that unlocking for you in terms of time saved, and what's that worth to you versus having a financial controller do it for you or something along those lines?
Yeah, no, I think that's exactly right. And just last point on this is to your point about like capped upside. There's a whole conversation that needs to be had at sort of a tech industry level about how we sort of finance all of this stuff, because I think the dominant VC thinking of this is too small for VC, therefore it's a bad idea, therefore it shouldn't exist and no one should build it. Like I got really tired of that over the last 10 years. And there's a whole bunch of sort of vertically specific software that I think should be built and has a really good prospects as a business, but probably doesn't fit the way that at least most VCs think about the math of what they do. And so I'm curious to see, particularly as, I don't know, I saw a tweet from, maybe it was Frank Rotman at QED, who was sort of talking about we're going into a risk-off era rather than a risk-on era, which we've been in. Everyone sort of adjust your scorecards accountingly. Like maybe the shift in the macro environment will sort of change the way that funding works. But I hope that some of these little kind of capped upside plays still make sense for people to pursue.
Yeah, I don't know if we're fully risk off just yet. We might have a little room to run, but
well, it depends on if tariffs are happening or not, Simon. It changes.
Yeah, we'll see. I think we've got a little bit of time, but we will end up in risk off, and there's
yes.
a trend happening underneath the surface when that happens, because we've seen this movie. If anybody remembers 2022, it sucked. And
it was not
that
fun.
will come back again. And when it does, there's a new type of firm being launched by VCs and former VCs, which is just going around buying up all of these small businesses as distressed assets. And it's like a modern day take on PE. They're just good businesses. They're good internet businesses, but they have capped upside. So buy a bunch of them. And they're profitable. It's great. But they were just backed with this ZERP era VC model, which is not true VC. Not the Bill Gurley of the late 90s, early 2000s.
Yeah, it's just spray VC money around. Yeah.
Because the AUM model of venture capital, where you raise $3 to $5 to $7 billion funds, can only be deployed in so many places. There is only so many great companies in the world. So there's just got to be a limit to that. So you have to do different things, and you become a crossover fund, but you also do this. You also buy into different things, or you start buying into internet infrastructure, which you see with Stargate and data centers, and going into robotics and many other things. So it's changing shape, and the software company of old is also much cheaper to create than ever before.
That's right. AI, That's right.
With the new tooling. So let's see where it goes.
I like it. All right, Simon, give me your second company.
So I pivoted because I was going to do another stablecoin company, but I want to do something a little bit more Alex Johnson. So
okay, that's fair. That's fair.
Here's something a little bit more esoteric. So imagine
Alex Johnson being code for esoteric. It delights me, actually, Simon. Thank you.
You just love a slightly off kilter thing that surprises you. Might not be the biggest company in the world, but is interesting. So yes, I think this fits the bill. I don't even know how to pronounce it. I think it's Sencillo, Sencillo. So imagine home equity loan financing, or HELOC, meets school fees.
Ooh.
So it helps parents spread the cost of daycare and private school fees in the United Kingdom in particular by unlocking their home equity. Spread those fees over a longer time period than the 2 or 5 years the kids in that particular school, to make the short-term costs lower by unlocking that home equity. And then you use kind of the various documents from both your home and the school to be able to ensure that that's what the funds are going to. So it's partially verified. And this struck me because I know it's kind of similar in the US, especially in some of the metropolitan areas, but childcare fees are often higher than a mortgage.
Yeah. And they're crazy.
Those fees are about to be subject to an additional, or a full 20% sales tax in the UK. So they are not tax deductible at all. So they're just about to increase by another 20%. So, if you're ultra wealthy, doesn't matter. That kid's going to be fine. But many of the middle class striving families, a lot of immigrant first and second generation families, really bend over backwards to try and get their kids into private schools, to give them a ticket to play the game, to get them up into the market. And maybe unlocking home equity is a way for them to do that, especially if they came in and bought their home 10, 15, 20 years ago, or they have some family equity there. So what do you think of this model? Because I'm really conflicted on it.
So I'm conflicted as well. The conflict stems from the fact that I've learned to be very suspicious over time when the wedge for a product relates to affordability issues, right? Because that can drive negative selection or adverse selection, that can potentially lead to kind of predatory outcomes, right? Where you're sort of taking advantage of someone's desperation to be able to afford something that they maybe just should kind of reassess trying to buy in the first place. So affordability as a driver of the product, that would be more of my concern comes from. Having said that, It's definitely a problem, right? Like I think childcare costs everywhere in the developed world are just like going up and up and up. I mean, this is sort of fintech dad podcast for a second, but like we both have kids. It's really expensive, right? And you don't even have to be opting for like the platinum tier version of childcare, which can be a little silly actually. But even just like kind of run of the mill, kind of medium childcare is incredibly expensive, and so tying that together with sort of a novel way of unlocking access to liquidity, I'm, not opposed to that at all. I think that concept makes sense. We do see, at least in the US, lots of examples of home equity as sort of a vehicle for that liquidity, right? Because historically, the challenge with home equity is it's really expensive for banks to do, right? So they don't really tend to like home equity relative to other products. Depending on what the mortgage market is doing and where interest rates are, it'll sort of unlock these little windows where HELOC is a good business. But in general, it's not like a durable thing that banks like to do, just because it's really expensive. There's a lot of sort of underwriting costs that go into making sure like you have a good understanding of the actual value of the home, confirming all of the details. It's expensive like mortgage, but it doesn't have the same sort of upside and sort of infrastructure wrapped around it. So home equity is generally annoying to banks, which has created an opportunity for fintech companies to come in and say, look, we can apply technology to make the process of doing the home equity origination much faster and lower cost. And so like we have Avon Card in the US, which is like a home equity backed kind of credit card. So it's like another way to tap into home equity liquidity and use that for spending. This is going a step further, which is kind of interesting to me. It sounds like by tying home equity to the specific thing that you're spending it on, right? So you see this sometimes in lending where the money is being confirmed for a specific thing. And we do this in mortgage, right? Like when you get a mortgage, the bank gets verification that you're taking that big check that you got from them and you're actually using it to buy a house, not something else. So that form of lending where you're confirming what the funds are going to, that's very common. Applying that model to different costs like childcare and being able to sort of, it sounds like this platform handles the documentation from the childcare provider and like verifying that and making sure like the ability to tie those things together from a lender's perspective, that gives you more comfort, right? Because you have a better sense of what people are spending it on, and you can sort of underwrite the risk of that differently than if it's just, hey, I want to tap into my home equity line to go have fun. Like you don't know what they're going to spend that on, and that might be sort of a greater kind of adverse selection and risk that you're dealing with. So I would say I like the combination of tying sort of a category of expense in a confirmed way to the loan. And I like being able to tie home equity, which I think is something that those middle class strivers that you're mentioning sort of are more likely to have, to that expense and making that sort of more automated. I guess the question I have is just how big a market is this? It seems very niche, like in a cool way. Like this is a perfect fit for a segment of the population. How big is that segment? Can you capture close to 100% of it? Is this something that you sort of white label and make available through all the other channels where people are going to get home equity loans? Like how do you even like acquire a customer by saying, look, it's likely that you have kids and that you're worried about childcare expenses and you have a home? Like I'm sort of trying to triangulate on like how big is this customer segment and how do you get to them?
Yeah, and the distribution side of it is fascinating because it feels like they're doing hand-to-hand combat if you look at their website, which would be not necessarily scalable, especially in the United Kingdom, which, it's sort of 70 million population, 34 million working adults, of which about sort of what you could probably reasonably put about 5 million in the sort of would send their kids to private school, has home equity. Like it's not a massive market. You're going to address 1% of that. You got a 50,000 conversion rate per year. Like it's even if you do the sum whatever analysis, it's not massive. But if you flip the distribution around working with the schools themselves and it being a financing option that the schools could give to the parents, then it becomes a way to get into the school to deal with this new, because the timing here is key. You've got this sudden tax hike, and how do you deal with the tax hike? A lot of the schools are trying to smooth out their fees over multiple years so that if you had a kid already in year one, you're not worried about year two, year three. They're gradually increasing the fees and smoothing it out for those parents. And they're taking some of the hit on that from their previous year's profitability. So the schools have an incentive here to be able to do something on the childcare side that I think is kind of unique and circumstantial. I also liked your point about adverse versus positive selection.
Yeah.
If you think about these families that would be wanting to take out a loan to send their kid to a private school, that is a positive selection signal that person is going to do everything they can to pay something back. The kind of person that is conscientious enough to try and push their kid through private school and make it work is probably somebody that's going to pay back a loan. So I've not seen home equity loan financing at all in the UK. So I think you're really pushing hard against something. But then there's a lot of stuff popping up in the UK in the last sort of 2-3 years that I hadn't seen before. We have a lot more Wendy's now. Suddenly we have Popeye's chicken. I wouldn't be surprised if Chick-fil-A moves in soon. Like literally brands that I only ever saw when I was like hanging out with you crazy Americans are now everywhere around me. Maybe it's a post-Brexit thing. So who knows? We might get home equity loans too. And I guess it's sort of, I'll come onto it in manifesting a little bit more, but it speaks to a point that I have more broadly, which is it's just too damn expensive for childcare, and I want to get creative for solutions.
Yeah, no, I think that's totally fair. I mean, it's funny the idea that you're just sort of importing all of our cool ideas like Chick-fil-A and home equity lines of credit. Let's get into more debt and get fat. Love it. Yeah, no, I mean, like, join us. It's awesome. You're just gonna love it, Simon. Yeah, I mean the the home equity thing is positive selection, right? Because to your point, you're sort of combining two different populations that are probably pretty good from a risk perspective. One is parents who are ambitious for their children and want them to go to private school. Okay, like that's probably a pretty good bet to take. The other one is, hey, they already have a house and they've built up some equity in it. Like that probably took some work and some like planning and some financial management. So you're sort of like fishing in the combination of two pretty good pools. So I like that from a risk perspective. I will warn you, Simon, a thing you should not import to the UK, which we already have in the US, are home equity investments. So like a key distinction here that's interesting to watch out for, and the CFPB actually put out some information about this recently, which I was glad to see. You can do a loan against someone's home equity, or you can essentially buy a portion of someone's home equity in exchange for cash. The loan option is much better and much safer and much sort of more clearly regulated. The home equity investment contracts, that's been kind of a little fintech innovation in the US. I am not a fan of that because that then gets you closer to that line of kind of being predatory, where essentially you're capitalizing on someone's desperation to buy the equity and upside that they otherwise would be able to realize themselves. So I would prefer to see these types of things structured as loans rather than as equity investments. But in home equity, you do see people kind of flirt with that line a little bit. So we'll see if that evolves at all now that we're in a different regulatory environment. But that's another kind of trend to watch out for to our friends across the pond.
I'm always here for the watch outs. I'm watching out for your final company. Hit me up with who you've got.
All right. Well, mine is both a continuation of a theme, as we've been talking, and it is also, I think it's esoteric. I think you'll like this one. And this one's called ClosingLock. And I'll describe the problem in the US. I'm guessing at least some flavor of this has probably popped up in the UK as well. Wire fraud in real estate transactions is a huge, huge deal. It kind of came out of nowhere. I think from what I understand, it's really become prevalent in kind of a post-COVID environment, but it's similar in a lot of ways to like the rise in check fraud, which is like when technology and people and systems move in one direction, fraudsters are like, oh, hey, look, a soft target over here. And so like an unforgotten corner of fintech and financial services is all right, we're going to buy this house. We have a loan, we have the agreement, everything's all set. And now we actually need to transfer the money, and we need to run this transaction through the title company. We need to transfer money from a bank. We need to, make our down payment. All of these sort of components that go into the final last mile of a real estate transaction. Well, it turns out, not surprisingly, I guess, that a lot of the systems that are used to do that is literally just, the title company sending you an email and being like, hey, here's the
Wow.
wire instruction for where to send your down payment. I did this actually, multiple houses that I've bought over time. I don't know multiple houses, but as I've bought a house, sold a
Well,
house, bought a new
your
house.
monopoly kingpin property empire.
Right. I don't want it to sound like that. It's not nearly as fancy as that. But in the few times I've dealt with the real estate market, not that long ago, actually, I did this exact thing. Right, like they would send me wire instructions via unsecured email, and I'm just like, okay, here's my wire for whatever $80,000. Like enjoy. And turns out that's really easy for fraudsters to get themselves into the middle of. And they have been doing that. In fact, in 2023 in the US, there was something like $3 billion in losses due to about 31,000 fraudulent sort of transactions within that last mile of real estate, which averaged out to about $143,000 lost per transaction, which is crazy. And what ClosingLock does is they basically provide a secure real estate payments platform. And so it's just a system for identity verification, for document upload and verification, and for secure payments. And so fairly straightforward, fairly simple. There's not really anything that I look at with this one that's like revolutionary. A lot of commercial payment systems work exactly like this, right? Like it's a system that both parties can access. It verifies your information. Remember when Citi accidentally like fat fingered a number and sent like the wrong payment to something? Like those types of systems exist. Obviously, they are subject to fat finger errors, but like we've had these types of electronic systems with verification and safeguards built into them in all other facets of financial services for decades, but we haven't really had it in real estate. And so that's what ClosingLock does. They actually, as a part of using their system, provide insurance on the payments up to
Wow.
$2.5 million. So essentially, if you use their platform the way it's designed to be used and it does all the verification of identities of different parties and all the things it's supposed to do, they're comfortable insuring those transactions up to an amount, which creates that like level of comfort. Apparently, they have pretty established partnerships with large banks like JP Morgan Chase. So I don't know, Simon, this struck me again, kind of like the Anchor Agree one is like, why didn't this exist before? This makes a lot of sense.
Yeah.
ClosingLock seems to have sort of gotten itself. They just raised a Series B, so they're sort of in a position, I think, to capture a large part of this market. But it's a good reminder to me that there are just these like corners of financial services still in 2025 that work in the most like unsecure, unsafe, you would never design it in a million years if you were designing it this way thing. And we just sort of live with the risks when we don't have to. I think that's fascinating.
Wire fraud is spiking. We see that at Sardine, and there's a bunch of good things that everybody should be doing to prevent wire fraud, which is like try and look at every signal before the transaction. Try and validate the receiving account through something like Sonar to see if that recipient has any history of being negative, and account verification and validation and all of that kind of good stuff. You should do those things, and you should continue to do those things because you're still going to have wires that are not for real estate transactions.
Oh, so 100%. Yeah.
But frankly, wires, because they're such an ancient payment system, it is not really built for this type of fraud. It's not really good. It is just simply an instruction to move value. Like that's all it does, and it does it incredibly well. And you can move very large value, and it's very widely accepted, and it gets there near instantly. It's phenomenal, but that's extremely dangerous, and the fraudsters know this, and they've become highly targeted. There was an entire, I think it was a Forbes piece I saw on a criminal cartel. I think they were from Mexico, but there are many locations for cartels to be from that were targeting specifically real estate transactions, and this was their entire revenue for this one particular cartel to fund their local drug trade was in fact coming from this this mechanism. So it is a massive issue. When you mentioned ClosingLock, I thought that all it was going to be was escrow, that people were going to do some validation either side of it. Maybe AI was going to do some validation of the documents and the accounts and whatever else. And then it was going to just escrow the funds and then move it when everybody was really, really sure and make sure it was going to the right place. But I do think, sort of like the 2 checks that you get from WhatsApp or iMessage or whatever, the 1 check, 2 check, and then blue. That's sort of what the payment system needs more generally. Like, why isn't that sort of something that's baked into everything? I'm going to flip to manifesting, but that was kind of the thing that I think is really, really key. Is we need more trust in the financial services system. We need, if we are moving to more real-time payments, more instant payments, large volume payments, then we need confidence that where it's going is going to the right place. Yep, you've sent it. Yep, it's going to the right place. Okay, transaction done. It's those 3 steps that are not baked into these legacy payment rails, but maybe with open banking, maybe with some of the data we can share, we could do something along those lines. Because this is just such a massive issue. So they've hit Series B. They're starting to gain traction. Do you think that they're going to distribute via realtors? Are they going to distribute via the banks? Like, how do they get their customers?
Yeah, no, it's a great question. I mean, they talked in the press release about distribution partnerships with banks like JP Morgan Chase, and so I'm guessing that's probably a big one. And it makes sense, right, if you think about it, because whether the bank is the mortgage lender or the bank is the deposit provider of the customer who's about to send their nest egg to use as the down payment for the home that they've always dreamed of buying, like, there's quite an incentive, I think, on the part of banks to make sure that, like, I mean, shit, the biggest payment I've ever made was for my house, right? Literally, like, that's the biggest, like, dollar transaction that I've ever sort of authorized. Probably worth investing if you're the bank and making sure that your customers are authorizing the right transaction and are like 100% sure that it's going to work, and even that the transaction is insured by the platform that you're doing it through. So I'm guessing bank is probably a big distribution channel. It also definitely makes sense for real estate agents, for title companies. So there's probably kind of multiple ways to do it. And it sounded like, from my sort of glance at their website and reading some of their materials, they are trying to think about, like, what's the more expanded version of this? Like, if we start by just trying to stop wire fraud, which it sounds like they've already been pretty successful at doing at a pretty large scale, what are the other things that we can, like, back into? Are there ways that we can speed up the transaction? And if we speed up the transaction, is one party willing to pay a little bit more for the transaction to close faster? So there's probably sort of expanded things they can do once they get these payment flows. So in a lot of ways, it also strikes me as a kind of classic example of wire fraud in real estate explodes, becomes a huge problem. Everyone realizes they have no technology necessary to do this. Someone gets to the market first and captures that, like, hair on fire problem, and then they use that as the sort of beginning of a right to win in a larger set of, like, opportunities within that space. And the thing that's cool about real estate, just from a, like, if you're a founder and you're thinking about places to play, it's cyclical, right? Like, that's the unfun part, and rates and other things really affect it. The nice thing is, when it's booming, there is so much fat on the bone, right? Because these are huge transactions. Origination fees are huge. Like, there's a lot of margin to capture, right? And everyone from Black Knight to Equifax sort of has made a ton of money in real estate by sort of going after those very large margins. So I think that's the other thing here is, this is probably one of those products where, they could just make up a price. And I'm sure all the companies they were talking to were like, yeah, no, we're happy to pay that.
What's it worth to you to not lose $143,000?
Right. Exactly. Like, it's going to be a big number, right? And probably more than $5 a transaction. So I think that is interesting. It'll be interesting to see if they have some competitors or if this becomes more of just a standard way that this works in the future. Simon, before I let you go, you've hinted, but you haven't fully said what you'd like to manifest for the future of fintech.
Yeah, so I started out wanting to manifest something around just the cost of living and
Yeah.
childcare
Yeah.
generally being a real kind of key area. But I want to see if we can find the way to reorient the center of gravity in pricing. What do I mean by that? There's this idea that your margin is my opportunity, but that plays from the institution doing the lending to the customer. The customer is there to be profit maximized. And that's capitalism. Like, it's okay. And in a competitive market, that margin should be competed away. And I understand all the Adam Smith stuff. Like, I get it. But still, most of the margin and revenue in lending comes from breakage. It comes from people not doing the smart thing.
Yeah.
However, with wallets, with AI potentially, we are potentially seeing that role reverse where the intelligence sits on the consumer side, or at least a lot more intelligence sits on the consumer side. So your pricing starts to need to change, but also your access to data potentially changes, because if there is something sitting in my mobile device that can see everything I can see, then it could potentially help you price risk a lot differently, because what's the core issue with lending? It's information asymmetry. And how do I close some of that information asymmetry? By changing the perspective from the person doing the borrowing is able to potentially give an algorithm that is underwriting a lot more information and a lot more intention, without necessarily sharing things that are, need to be blind or can't be seen for regulatory reasons or whatever else. So can we have a more competitive lending market by sharing more data, by changing where the algorithm moves, by moving it onto the device a little bit more? I'm manifesting something really crazy. There's probably a bunch of reasons why it's not possible, but those are my favorite ideas.
No, I like that. I'm just going to build on yours, Simon, because I like this one. I've spent a lot of time thinking about it. So let me double down on manifesting that for a second. I absolutely think that can and should exist, right? And so, I guess the sort of key challenge I have with lending is that, to your point, profitability depends on, to a certain extent, kind of screwing the customer to the extent that you can get away with it. And that pricing model is just not going to be viable in the future, right? And I'm not saying it's like a horrible thing. It's kind of capitalism, to your point. Like I'm an adult. I realize how the world works. It's fine. The thing I want, like, lenders and financial services companies to take away, though, is AI and technology is going to break that model, right? Like the only reason you're able to get away with these things is because customers don't have a lot of time and they don't have the energy and resources to fight you or to do the best due diligence and shop around for the best deal. Technology will wipe away that advantage that you've had over customers for decades. And by the way, it will force you to be a lot less lazy as an organization, because you don't have that margin that you can just rely on and just sort of build a bunch of kind of cost centers around and be like, oh, it's fine. We can do this. We can throw a big party at Money 2020 and waste all this money. Like, it doesn't matter. Like, look at how great our business is. Like, that's going to change. And so when that changes, I think, Simon, to your question, the thing I wonder about is, how do you outprice your competitors, right? How do you build like a durable advantage with customers? And to me, it's exactly what you said, which is you need to earn access to things, to data about them that no one else knows. And that is a function of trust. That is a function of sort of a holistic value that you provide as a brand to that customer beyond the loan, right? Like, the dirty secret of lending is customers don't care who they get a loan from, right? Like, that's just like, they want a loan to get a thing. They don't care where it comes from or who it is. I'll get a mortgage from whoever gives me the lowest rate. It gets sold to someone else. I don't care. Tell me where to send my payment. Like, lending is a very unloyal business. It's going to have to become a relationship business. And when it becomes a relationship business, I think you're right. And we already see this with open banking and cash flow underwriting to an extent. The question is going to be, how can I leverage that relationship to have the customer share things with me that they don't tell other people or that other lenders don't know, that gives me an advantage in giving them the best price and keeping them as a customer. And I don't know exactly what that looks like. It probably does relate a little bit to on-device information. I could totally see it being sort of wrapped into like larger ecosystems that customers live within, like an Apple or something like that. But regardless of how you get that relationship and that data, that's going to need to be the way lending works, because this whole idea of like, I can acquire a customer, hope that they don't shop around, and then just sort of live off of the margin, that is going away. And if you don't think so, you have your head stuck in the sand. So we all need to adapt to that reality.
Here, let's adapt. Fairer pricing for all with better data that I can permission and be in control of. Oh, maybe I'm utopian, but what can I say? I sit in Europe. We just love a bit of utopia.
You guys dream big dreams. Well, I appreciate it as always, Mr. Taylor. We will get back together and do this again. Hopefully, I'll get more opportunities to see you in person again soon. But until then, be well. Thank you, sir.
Thank you, sir.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.